Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insight. So, very good morning. Today will be Wednesday, the 26th of June, 2024. Well, times really flies pretty fast. So now we're coming close, very to the tail end of the month of June, as well as quarterly Q2 end. So, before we start our Daily Dose of Market Insights today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monitored Authority of Singapore. All right, so the first and foremost, before we jump straight into the short-term intraday technical outlook on the key cross asset classes, let's have a recap what has taken shape yesterday in terms of news flow, economic data, and as well as what has also taken shape earlier today morning before the start of our daily dose, and how does it impact the respective cross asset prices. So let's start with yesterday first. So over yesterday, we do have a Fed speak that actually spoke yesterday, Fed Bowman. If you could look at my screen over here. All right, let me expand my screen so that you guys could see. So Fed Bowman is one of the, I would say that one of the officials that do not belong to the much more dovish camp. Rather, she belongs to Bostic camp. That means they are looking at more data dependent, and they do express a view of elevated sticky services inflation. And he did warn yesterday that there is still upside risk pertaining to inflation, and one of the potential upside risks could be potentially inflation expectation that is still remains sticky and it's not time to cut. So what do you mean by inflation expectation? So if I were to look at the screen over here, there's this particular chart that you can monitor is looking at the 5-year break-even rate over here. So the one that is orange and dark blue is the break-even rates of, okay, it's hang on the screen, it's hang for, yeah. So the dark blue is a 5-year break-even inflation rate. The 10-year is orange break-even inflation rate. So this break-even inflation rate is being derived from market transacted treasury instrument, which is the treasury inflation protected securities. And what's interesting over here is that this break-even inflation actually implies what the market is expecting 5 years from today inflation will be. So markets are expecting inflation to still remains at 2.22% on a 10-year basis and on a 5-year 2.17%. So what you could see over here is that it seems to us that it refused to break below that 2.10 level. All right, there's a kind of a supported area around the 2.10 level and 2.2 level for both the 10-year and the 5-year break evens. So that actually expressed to us that inflation expectation seems to be anchored at this level. So that is kind of a sticky elevated level. And what the Fed desired is they want inflation to actually be down at 2% before they will be more confident to start cutting interest rates. And do not forget, the movement of this 10-year break even is moving in similarity with this dark green line over here, which is oil price. So if you look at oil prices right now, it's still rather firm. I would say it didn't collapse despite the last OPEC Plus meeting, where OPEC members decided not to extend the additional supply constraint or cut to the market beyond September this year. All right, and from there they will see how the oil dynamics unfold. And if you look at the last few weeks or 2 weeks or so, oil managed to actually stage a bounce as well. So it seems to us that oil price also able to find a floor somewhere between the $74 per barrel, and the top side seems to be around $90 per barrel. So given that if oil price continues to stay firm within this range, there's a high chance that inflation expectation will remain firm above that 2.2 level, 2.10 level respectively for the 5-year and 10-year break even. So that actually express the mindset of this particular Fed officials over here, Fed Bowman, the rationale for her or him to remains rather vigilant due to the upside risk on inflation. Okay, now based on this less dovish Fed speak yesterday from Fed Bowman, how does it impact the market pricing of interest rate trajectory going forward this year and next year? And let's more concerned about this year first, all right? Because right now, based on the Fed funds futures pricing, for those who have followed up my daily dose on a regular basis, the latest odds skewed towards the September FOMC meeting. All right. So initially, at the start of this year, market has high hopes that the Fed will start cutting interest rate in March. But due to the latest Fed speaks and being more data dependent, and also some of the Federal Reserve officials has a view that inflation in US will continue to remain rather sticky, that actually pushed down the March expectation or the Fed dovish period to be a much more undovish period, okay, or dovish period unpivoted. And right now the market is hoping that the Fed will still cut this year, and they start to price in high hopes in the September meeting. So after Fed Bowman speech yesterday, the Dow hasn't really changed much. Means the pendulum or swing hasn't changed much by looking at the latest data from the CME Fed Watch tool. So like I say, this CME Fed Watch tool is a tool which is being we call it modeled by CME Group. So just Google CME Fed Watch 2. What they did over here is that they actually obtain prices from the Fed Fund futures pricing across the tenure, and they compile the expectation for us. It's not live, it's slightly lagged by I believe about 2 to 3 hours, but it's good enough to have a feel the current expectation on the interest rate futures market at this moment, what they are pricing in terms of odds of future potential Fed funds trajectory. So if you look at the CME Fed Watch 2, on the probability tab, we have these two boxes. The top box is what I call conditional probability. The bottom of the box is called aggregated probability. Okay, so let's look at the aggregate probability because that actually combines everything together. Now the Fed fund rate is at 5.25% and 5.5%. So pretty much unchanged for the upcoming July meeting. Market is still expecting no cut in the July meeting, but still has high hopes on the September meeting, despite yesterday's Fed Bowman not so dovish Fed speak. Still looking at a chance of 72%. So that's more or less it's one cut before 2024 ends, and no change during the November meeting, and a chance of 80%, I would say that's quite high or quite optimistic in the December FOMC meeting, to be precise, 18th of December. The interest rate futures market is still expecting one more cut before 2024 ends. That means at this point in time, market is expecting 2 cuts. All right. So is it rather bullish in terms of the optimism? I would say possibly yes, because in the end, the Fed itself is still on a guidance of data dependent, and being data dependent, every announcement of new data coming into the market will cause volatility either up or down, because the Fed is always looking at being a data dependent approach. So i.e., if US PCE inflation data this coming Friday, we'll talk more about that tomorrow, spike up beyond expectation, because market is expecting PCE to decelerate, but if they don't decelerate and it can spike up, that could disappoint market again and it cause volatility, and that could actually cause the dollar strength to eruptively rally as well. Okay, so this is something I want to share with you all, in terms of the fundamental. Okay, so other than that, what we have over here is we do have one economic data release early today morning Asia session time, will be the Australia CPI data. And bear in mind, Australia CPI market do expect a slight chance of RBA hiking rates this year going against the peg. Why? Because of stubborn elevated inflation in Australia. And this particular scenario did indeed support or play out by this latest monthly CPI indicator that's out at 9:30 a.m. Singapore time today. It actually shoot up to 4%, way beyond 3.6% that was printed in the month of April, and also 2 basis points higher than the expectation of 3.8%. That's for May. So if you look at the monthly CPI indicator trend from here, what we could see over here is that we start to see a rather spurt up or a reacceleration of inflationary pressure in Australia. So 4%. So that is actually the highest level so far recorded this year. And very clearly, if we were to look at the 5-year trend, that is a big turnaround. Okay, so that actually also kind of supports RBA rather muted hawkish stance based on their last RBA monetary policy statement and the press conference that it was actually being foretold later by the RBA governor, looking at a possibility of there could be a risk of RBA going to hike rates potentially again due to inflation in Australia still remains rather firm, and with the potential pressure of reacceleration as being shown on this monthly CPI indicator. So that actually explained to us the medium-term trend of the Aussie dollar that is still stuck within this symmetrical triangle range configuration that I tend to flash out in my daily dose of market insights almost every day. So later I'll flash that again. So on the upside, we see Aussie dollar being we call constrained by general not so dovish Fed, but on the downside, the Aussie dollar is also being supported by fundamentals, which is a potential reacceleration of domestic inflation pressure in Australia, preventing the RBA, which is Australia's central bank, from enacting its interest rate cut cycle, and perhaps potentially they may be forced to engage at least one interest rate hike again before 2024 ends. Okay, that's actually a possibility. So that sums up the fund news flow data that I will share with you all for today, right? In terms of the current aspect of things that I feel that is important for us to know. Now, let us now jump straight to another fundamental, we call it a showcase for our daily dose is the intermarket dynamics. All right, so let's look at the intermarket dynamics right now, more pertaining to the FX market. All right, so on the FX market over here, so let us now go to the 10-year treasury yield and the 2 year. Let's start from the 2 year first. All right, so the 2-year US treasury yield continues to remain rather soft. Okay, it's trying to trade sideways ever since the bearish breakdown on 13th of June. It's just traded sideways, and yesterday's not so dovish Fed speak prevented it from decelerating further. And bear in mind, the 2-year treasury yield has a very close sensitivity to the movement of Federal Reserve policy because they are considered the shorter end of the tenure. So yesterday's what I call it less dovish Fed speak from Fed Bowman, encouraging that potentially she do not actually supports a cut in 2024 if inflation pressure continues to remain elevated in US. So that actually prevents the 2-year treasury yield from slipping down much lower and breaking below the 18 June low. But so far it's been trading in a sideways movement, but neither also showing signs of bullish reacceleration because it's continued to be trading below the 200-day moving average and as well as the downward sloping 20-day moving average. All right, so now let's look at the 10-year, the longer tenure. Okay, the 10-year US treasury yield. Okay, give me a minute, it's a bit slow. Yeah, this is the 1 year. Okay, 1 second. Yes, so this 10-year treasury yield as well also remains rather in a sideways fashion. Yesterday can't break below the 14th of June low over here, and ever since in the last 1.5 week it's been trading sideways, but also rather remains soft at this juncture. So what we could see over here is that it's still trading below the 200-day and the 20-day moving average. So this will give this softer US Treasury yield, despite the fact that not so dovish Fed speak from Fed Bowman, it did actually see a kind of acceleration in the US dollar. So if you look at the US dollar continues to be constrained within a very near term sideways range configuration that I highlighted yesterday, which is this level here. All right. On the upside, 106.37, which is the minor swing high area, the medium term swing high area of 17th of April and 26th of April, and this medium term descending trend line that is in place since 5th of October. So this is the dollar index. Using the dollar index to have a general view of where the movement of the dollar potentially could be. All right, and on the bottom side, it's being supported by this rising 20-day moving average, which is acting as a support at 104.93. So it could actually continues to be trapped between the upper limit at 106. Okay, let me put it in. Okay, sorry, let me put it in bold it so it's much more obvious. And the lower part of this range, okay, 104.93. So it could be trapped between these two levels, 106.37 and 104.93. And do not forget over here is that the dollar is also still being used as a safe haven asset in terms of safe haven demand, I would say, in terms of rising potential geopolitical risk. And right now, the clear and present geopolitical risk, yes, is not really coming up from the Israel and Hamas conflict, but much more markets more concerned about the outcome of this local French legislative election, the first round that's going to be held on Sunday. And based on the latest polling results, not the actual result, polling results, it shows to us that the National Rally Party, which belongs to the far right, may gain a significant foothold in the French legislative election or the legislative house, which in turn could increase the budget deficit of the France economy due to their rather aggressive expansionary policy, which could potentially increase credit risk in Eurozone. Okay, that bearing in mind that the France economy is one of the key anchor economy in the Eurozone, other than on top of it, or on top, the other one will be Germany. Okay, so that's explain the reason the dollar is being kind of being supported as well, but on the top side is being kept at 106.37 due to a softer 10-year and 2-year US Treasury yield. All right, and based on the US stock market performance yesterday, very quickly, we do see a resurgence of the mega cap stocks. All right, the mega cap stocks. So what I could see over here is that yesterday we do see a stellar outperformance of NVIDIA, which is a very, very important influence on the S&P 500 and as well as the Nasdaq 100. Why? Because the year-to-date performance of the S&P and Nasdaq 100 has a significant contribution solely from NVIDIA because of a hugely market cap weighted status that is increasingly on a very, very tremendous, we call it market share gaining in the last 2 months or so, because this at one point in time last week before that 3 days of sell-off in NVIDIA that took shape on last Friday and Thursday, NVIDIA itself on Wednesday managed to actually surpass Microsoft to be the #1 biggest market cap weighted stock inside the S&P 500 and as well as the Nasdaq 100. And right now it's now dropped back towards the, I think, third and second placing. So given yesterday very strong push up in NVIDIA, it causes the other AI related mega cap stocks like Google and Meta to actually outperform the general market as well, and also outperform within the mega cap stocks, the 7 mega cap stocks over here. All right, so overall I could see over here is that the market breadth itself is not that great because there are more reds than green. The only fact that because the green are heavily concentrated in the mega cap stocks, that overall causes the rally of the S&P 500 yesterday to shape a kind of a V-shaped reversal, but only concentrated on the mega cap stocks. So overall, you see outperformance on the S&P and the Nasdaq 100, driven by this mega cap stock led by Nvidia. Outperformance of Nasdaq at 1.16%, the S&P up by 0.9%, and yesterday, prior outperformer in the last 2 days now rotated to be an underperformer. The Dow Jones down negative 0.7%, the Russell down negative 0.4%. So later I'll touch on the short-term technical outlook on the Dow Jones and as well as the Nasdaq 100, taking into account of the current latest price action. All right, so now this is the latest dynamic that I was seeing right now. So in terms of the intermarket dynamics, and right now let us now jump straight to the short-term intraday technical outlook, starting with the FX market first. So before we jump straight into the individual major dollar pair, let's have a quick look at the rolling short-term 5-day performance of the dollar against the other major currency. Okay, let me expand. Oops. Okay, I think it's a bit slow on my system today. Okay, a bit hang for 5 days. Okay, so what we could see over here is that the dollar's major pair, the dollar against the other major currency. So this is a 5-day rolling performance. Okay, hopefully I can adjust this. Let me change this. Okay, it should be latest date is today, 26. So that just to be very clear. Okay, so if we look at the current situation over here, the rest of the dollar major currency, especially the dollar against the euro, the dollar against the sterling, even the dollar against Sing, the dollar against Kiwi, the dollar against CNH, and the dollar against Aussie, and the dollar against the CAT. Okay, so the dollar, before I talk about the dollar CAT, we talk about this over here first. That means, i.e., the dollar against the euro, the dollar against Sing, the dollar against the pound, the dollar against the Chinese yuan, and the dollar against the Aussie is being trapped in the sideways range. All right. And very interestingly, the dollar continues to strengthen against the Japanese yen and against the Swiss franc on a very short-term basis. This is the 5-day rolling performance. And the dollar underperformed against the dollar Canada, I would say. So if you look at over here, is that the dollar is weakening considerably in a short-term basis against the Canada dollar. That's why you see a kind of a gentle downward sloping dollar CAT. Okay, something interesting, mindful to look out for. So overall, what we could see over here is that overall there is no clear signs of either across the board dollar strength or across the board dollar weakness as being expressed by two conflicting factors that is playing out right now. Dollar strength being supported by potential rising geopolitical risk premium out from the Eurozone due to the upcoming French localized parliamentary election, but dollar strength is being kept on the top side by a softer US Treasury yield. So that actually is also being depicted if we dive down deep into the 5-day rolling performance of the dollar against the major, we call it currency. Okay, now with that, let us now jump straight to the individual technical outlook, starting on the FX pair that we cover on a daily basis, starting with the euro dollar first. All right. Okay, now euro dollar. Okay, before I go on to the euro dollar, let me expand my screen so that you guys could see. All right, good. So let's start with the euro dollar. So I could see over here that euro dollar yesterday did a slight push down during the start of the US session. But what's interesting over here is that after the push down, it managed to actually shape this bullish reversal hourly candle right at the 1.0695 pivotal support that we highlighted yesterday, and also managed to reintegrate back above this former descending trend line resistance, now turns into a pullback support level. So no change as it continues to trap within this sideways range configuration that has taken shape since the low of 14th of June. All right, this is kind of sideways range configuration you could see. So still using 0.695 as my short-term pivotal support on the intraday basis. Still maintain that short-term intraday bullish bias potentially we in this short-term sideways range configuration. The first near-term resistance to watch will be the top of this short-term range, means the range top intraday basis, because it's the hourly chart at 1.075 that has prevent the boost from breaking out since 18th of June. Okay, so this is a short-term intraday basis. Only a clearance above 1.0750 may expose the next intermediate resistance zone at 1.0770 and 1.0790, which is also confluence with the 200-day and the 20-day moving average, I think, as a resistance zone at this similar level as well. So only an hourly close breakdown with an hourly close below 1.0695 will invalidate this short-term intraday bullish bias to see it floating down towards the medium-term support level at 1.0656, which is also close to the lower limit of this range. So what's this 1.0656? So it's in fact a medium-term ascending trend line that I drew from the low of 2nd of October. So net overall, given the ascending trend line that I drew from 2nd October and the descending trend line that I drew from 17th of July last year, it could potentially means that from a medium term perspective, the euro dollar is also being trapped inside this kind of symmetrical triangle range configuration as well. All right, this is something for us to take note of if we were to look it from a longer term perspective. All right. All right, so these are the key levels to watch out for and the trend bias on the intraday basis for the euro dollar. Okay, now moving on to the sterling dollar. So the sterling dollar on the intraday uh, basis seems to be involving within a short-term intraday uptrend. Why? Because price continues to trade a series of higher high and higher low, and interestingly it managed to still hold above this rising 50-day moving average, whereas the price action of the euro dollar is being held below the 50-day moving average. All right, so no change as price action continues to inch a higher low. Yesterday I managed to print out a minor higher low over here, this low higher than this low, and the RSI is also sloping upwards as well, and it's right now at above the 50 level mark, so indicating to us some form of positive intraday uh, bullish momentum is still intact on the euro sterling dollar on an intraday basis. Okay, I like to stress this is an hourly chart, so what we are seeing over here in terms of time frame is just very short term, potentially looking at a time period of before the end of today's US session. So that's why I keep stressing intraday basis rather than multi-day, because I'm using an hourly chart. So from an intraday basis perspective, the technicals that I highlighted still remains positive, so still also support this potential bullish bias that we have on an intraday basis. So using 1.2620, which is the swing low of last Friday, and as well very close to the 50-day moving average as well. So no change, 1.2620 will still be my short-term pivotal support level to support this ongoing potential intraday bullish bias scenario. So what I'm going to have over here is that I will kind of adjust the first resistance slightly higher, okay, at this level here, 1.27 figure level. Above 1.27 figure exposes the next near-term resistance at 1.2740 on the intraday basis. Only an hourly close below 1.2620 will invalidate today's intraday bullish bias to damage this intraday uptrend as well, because it broke below the swing low and potentially sees the continuation of a minor corrective decline within its still medium term sideways range configuration to expose the next support area at 1.2565. So what's 1.2565? Graphically is the minor swing high of 7th of May and 13th of May. Now turns into a pullback support, and most importantly also confluence with the key 200-day moving average. But however, if we start to see a breakdown below 1.2565, then potentially it could translate to a short to medium term downtrend phase, because it's already broke below the 200-day moving average. But in first step, the next near term support level to watch on the intraday basis will be at 1.2515. Okay, 1.2515, this level, which is the minor swing low of 10th of May and 14th of May. Okay, perhaps let me put it down over here in words. 1.2515. All right, save it. Okay, so that covers the dollar against the European currency, which is the sterling and as well as the euro. So now let us move on to the Asia Pacific dollar major pair, starting with the Aussie dollar first. So what's interesting over here is that yes, we start to see a big spike up on the Australia dollar today. So given the fact that now it's also breaking above the 66.75 short-term pivotal support that we short-term pivotal resistance that we highlighted, this bullish breakout and bullish spike up is due to the hotter than expected monthly Australia CPI data. So with that, it kind of invalidate that short-term bearish bias that we have yesterday for it to float down towards 66.10 and 65.90, 65.80. So right now, potentially it could actually retest the upper limit of that symmetrical triangle range configuration again at 67.10 and 67.30. So with that, what I'm going to do over here is that since this level has already been taken up, let me remove it. All right. So what I'm going to do over here is that today's short-term pivotal support level to watch out for, okay, will be at the 200-day moving average at 66.40 level. Okay, 66.40, and given that the RSI is coming close to the overbought level, there could be a chance of a minor pullback. Okay, sorry, it's a bit hanging. It's a bit slow. I'm not sure what's going on. Okay, let me put it up from here. Okay, this level here. Okay, this congestion area. So 66.60, but I don't put it so tight as my short-term pivotal support level, because if we look at the last few days, it's still kind of having this wild swing, but managed to actually, this wild swing managed to help quite considerably well above the 20-day moving average. All right, so that's why I'm using that swing low area of today's Asia session low as well, where we start to see that bullish hammer take shape before that strong bullish hourly candle, reinforced by that hotter than expected Australia CPI data release that I highlighted earlier. So very clearly, this is a key positive psychological support that in order for the bulls to maintain this current intraday bullish momentum. So 66.40 short-term pivotal support level, flip to a short-term intraday bullish bias. Next resistance to watch will be the medium-term resistance zone of 67.10 and 67.30. Only an hourly close below 66.40 will invalidate this short-term intraday bullish bias to see another round of very messy, choppy decline movement to retest 66.10, which is the 50-day moving average as well. A break below it exposes the minor swing low area of 10th of June and 17th of June as this zone of this support zone of 65.90 and 65.80. So why do I say 67.10 and 67.30 is a key medium term resistance zone? Because of the daily chart of the Aussie dollar is still trapped within this symmetrical triangle range configuration since the low of 13th of October and the high of 3rd of February last year. So previous rally has been kept by this medium-term descending trend line of that symmetrical triangle range configuration, but bottom on the downside is being supported by this ascending trend line of that symmetrical triangle range configuration. So the upper limit of this symmetrical triangle range configuration, which is the descending trend line, is now coming to as a resistance at the 67.30 level. All right, so now moving on will be the dollar yen. So dollar yen, we continues to have a bullish bias yesterday. So no change. It's still kind of trading above the 15910 short-term pivotal support that we highlighted yesterday. So as long as 15910 short-term pivotal support holds, we still maintain that short-term bullish bias. First resistance to watch will be the 160.30, 160.40 level. So that level is actually in fact the swing high of 29th of April that actually saw that minor sell off in the dollar yen, very violent one, because this high point here at 160 20 or 30 level. So the area here induces the Ministry of Finance to instruct the Bank of Japan to intervene in the FX market by selling dollar and buying yen. So that's why it causes the very erratic short-term decline, right, on a volatility basis. So this is the first resistance level to watch. So market is also being very hesitant to actually break out of this level since the high of this Monday. But however, if we start to see a clearance above 160.40, the next resistance to watch will be at 161.10, followed by 161.80 level, because a clearance above this level also give a psychological impact on the market, implying that the Ministry of Finance doesn't want to actually intervene in the FX market yet, actually. All right, because in the last few days they only introduce verbal intervention, okay, rather than actual intervention. But however, if we start to see a breakdown below 15910, then this short-term intraday uptrend will be in jeopardy, and it could start to see a much more deeper pullback to expose the next near-term support at 15830/158 figure level. But the uptrend is still remains intact. Why? Because it's still holding above the rising 20-day moving average that is acting as a support at 15730, and this 15730 also correspond to the minor ascending channel support from the low of 5th of June. All right, so net overall, that sums up the short-term intraday technical outlook for today on the major dollar pair. So elements seems to be supporting at least some form of intraday dollar mix back. I would say it's a dollar mix back at this point in time. Now, major stock indices. So let us start from the Asia stock indices first. So on the Asia stock indices, let's start from the Nikkei 225 or the Japan 225, I would say. So the Japan 225 over here, what we could see is yesterday we flipped to a bullish bias because of the positive element where price action break above the 20-day moving average. And very interestingly, I could see that today's price action further confirm a positive follow through after yesterday's very clear up move above the 20-day and the 50-day moving average. So what it did over here, it broke above a 2-month range resistance level at 39,500. Okay, so the 39,500 has been capping the upside. Okay, it's a bit slow. I don't know why it's hanging. Okay, since 15th of April. Okay, previously hit here, decline, try to go up, hit again, then thereafter it's just shaped this very complex movement, sideways movement. So for today's Asia session, it managed to do a clearance at 39,500, and right now it's coming close to the next resistance at 39,880 that we highlighted yesterday as well. So what's 39,880 is in fact the minor congestion area over here of 4th of April and 12th of April. So with that current push up over here at this point in time, and with the hourly RSI at a very strong extreme overbought level, and this extreme overbought level is the highest that is seen within the last 2 months. Okay, we see in the last 2 months there's no overbought level that's higher than the current one. And with this extreme overbought level, there could be a chance of a minor pullback taking shape first before the rally potentially continues, since we have a bullish breakout above 39,500 on a bigger picture basis. So if you look at the daily chart, right, very clearly we could see this strong form of bullish breakout. Okay, very clearly this red line here, bullish breakout, and this bullish breakout occurs after forming a series of higher low above the 50-day moving average, and also kind of retested the medium-term ascending channel support, bouncing up before that bullish breakout took shape this morning. And the daily RSI hasn't even hit the overbought level yet. So on the longer time frame, on the Nikkei 225 or the Japan 225, evolving, telling us that in fact today's price action potentially could give birth to a multi-week uptrend movement. Okay, I'll extract this multi-week uptrend movement. Why? Because I'm looking at the daily chart. But if you do it on the intraday basis, because the hourly RSI is an extreme overbought level, a minor pullback cannot be ruled out first, okay, before potentially resuming its bullish uplift, okay, on the Japan 225 on the hourly basis. So the first support level to watch will be definitely the 239,500 level. So that will be like a range, key range resistance, now turns to a pullback support, using 39,230, slightly lower, as my short-term pivotal support for today. So if you look at the current move up over here, taking from this swing low all the way up to the current high, it actually responds to the 38.2% Fibo retracement. Okay, let me try to do something. Yeah, should be over here, 8.2% retracement. And in terms of a Elliott wave basis, okay, so we know that this is the 8.2%. This could be a minor bullish wave, impulsive one, corrective wave two, and right now it's the midst of doing that impulsive wave three, and the impulsive wave three may have already hit its target at 39,880 because there's a graphical resistance there. And if we do the Fibo extension, taking from the start, the end of wave one, break down to the wave two, okay, it corresponds very closely to 2 times as well. Okay, it is at the 40,000, which is slightly above the 39,880. So there's some form of Fibo retrace, Fibo based resistance, graphical resistance that is coming soon, coupled with extreme overbought level on the hourly basis that could actually support this potential minor pullback. And this potential minor pullback could be that minor wave 4 that tends to actually store at the 38% Fibo retracement as well, which also correspond to that former very clear graphical former minor swing high of 11th of June and 13th of June now turns into a pullback support level. So as long as this minor pullback didn't surpass below 39,230, we will still maintain that short-term intraday bullish outlook, because I can't tell how long, when will this minor pullback ends, but there could be a minor pullback coming to play. So just taking into account these levels to watch out for: 39,230 short-term pivotal support to hold this potential minor pullback, still maintain that short-term intraday bullish bias. Next resistance to watch on the upper limit will be at 40,230. So what's 40,230? Very clearly the congestion area of 25th of March and the former minor swing high of 4th of April, acting as a next near-term resistance next on the Japan 225. Only an hourly close below 39,230 will invalidate this short-term intraday bullish bias to see a deeper pullback unfolding again, to retest the 20-day moving average that's acting as a support right now at 38,750. Below it exposes the 50-day moving average that's acting as support at 38,460. Okay, so that's for the Japan 225. Now, moving on will be the Hang Seng Index of the Hong Kong 33. So the Hong Kong 33, we do have a short-term intraday bearish bias yesterday, holding below 18,300 short-term pivotal resistance, which is also confluencing with the downward sloping 20-day moving average. So what I could see over here is that the price action on the Hong Kong 33 for today, yes, is spike up during the start of the Hong Kong stock market opening session, but it refuses to break above the 50-day moving average. So overall, right, what we could see over here, let me highlight to you in a darker shade. There seems to be a minor descending trend line resistance that is capping previous upside move, and on the bottom there is a minor ascending trend line support that is supporting previous price action from breaking below it. So it seems to us that right now, since the low of 17th of June, the price action involvement of the Hong Kong 33 or the Hang Seng Index seems to be taking shape of a minor symmetrical triangle range configuration. So with that, now it's actually floating to the upper limit of this symmetrical triangle range configuration. So very clearly, also below the 18,300 short-term pivotal resistance that we highlighted yesterday. So still no change, still use the 18,300 short-term pivotal resistance as a key level to maintain our short-term intraday bearish bias, for it to float down towards potentially the lower limit of this minor symmetrical triangle range, which is also acting as a support level at 17,780. Only a breakdown below 17,780 will see the bearish breakdown of this symmetrical triangle range configuration to expose the next support at 17,600, 17,460 next All right. However, if we start to see a clearance with hourly close above 18,300, then that will actually invalidate today's intraday bearish bias to see a much more minor recovery taking shape on the Hong Kong 33. Next resistance level to watch will be 18,450, the minor swing high of 19th of June. Then thereafter followed by 18,730 next. Okay, if 18,450 is taken up to the upside. Okay, that's for the Hong Kong 33 or the Hang Seng Index. Moving on, next will be the German DAX or the German 30. So the German DAX and the German 30 yesterday did a bearish reaction off from the 18,380 short-term pivotal resistance, pardon me, not support, pivotal resistance, and hit the first support level at 18,107, 18,107, this green line here, before staging up a bounce throughout the US session. All right, so right now still no change, still holding below the 20-day moving average, I think as a resistance level at 18,380. So as long as 18,380 still remains resistance, we still keep a short-term intraday bearish bias again. First support level to watch for sure, no change at 18,107. Only a breakdown below 18,107, potentially revisit last Friday swing low area at 17,990/17,930. Only an hourly close above 18,380 will invalidate today's short-term intraday bearish bias to see a much more extensive recovery scenario on a minor base or on a minor time frame or minor basis on the German 30 or the German DAX. Next resistance level to watch 18,520, then thereafter followed by 18,640, 18,685 next on the German 30. Now, next one to look out for, we'll be shifting our focus to the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30, yes, even though yesterday it did underperform the Nasdaq 100 and the S&P 500, but it still managed to hold above our short-term pivotal support that we highlighted, 39,090. So 39,090 also correspond to the lower limit of this minor ascending channel that has taken form since the low of 14th of June over here. So still no change. Price action also managed to actually hit the oversold region and managed to exit up from it. So 39,090 short-term pivotal support holds. As long as this level holds on the Dow Jones Industrial Average, which is the US Wall Street 30, we'll still maintain our short-term intraday bullish bias on the US Wall Street 30. So for today, I do have a shorter first resistance level to watch out for, given yesterday's price action push down. Okay, will be at this level here, 39,290. Above 39,290, revisit this Monday swing high area at 39,600. All right, only hourly close below 39,090 will kind of invalidate today's intraday bullish bias to see a much more deeper minor corrective pullback to retest the rising 20-day and the 50-day moving average that is also confluencing very closely to this minor graphical support level at 38,730. A breakdown below it sees a further much more deeper corrective pullback for the next near-term support zone to come in at 38,560/38,420. We also confluence with the rising ascending trend line that I drew from the low of 30th of May. Okay, so now let's move on to the Nasdaq 100. So before I touch on the Nasdaq 100, we know that the Nasdaq 100 is being influenced by NVIDIA, which I explained earlier in the start of today's daily dose. Let's take a look at the technical picture of NVIDIA. All right. Okay, do let this template to load for a while, because it seems to us that while we are on this go-to meeting, it takes a bit of time for the live data to load up into it. All right, so now NVIDIA. Okay, where is the NVIDIA? Oh, over here. Oops, sorry. Okay, let me expand it. AVDA. Okay, so we could see NVIDIA in terms of the price action of NVIDIA yesterday. Okay, it managed to actually did a U-turn right at the first support that we highlighted, which is close to the 23.6% Fibo retracement, taking from the last we call it medium-term upswing from 19th of April low all the way to its all-time high that was printed on last Thursday. So very interestingly, a bounce off the first support and a bounce off the 20-day moving average. Okay, and yesterday bounce off seems to be rather positive in terms of the element itself. All right, the bullish candlestick is rather white in terms of the body of the bullish candlestick, and the volume that accompany yesterday is also considerably relatively high as well, and is higher than the previous bounce that was actually formed on the 18th of June. Okay, you could see over here this single day bounce volume is higher than the previous day, the previous bounce volume of 18th of June, and even much previously from 10th of June and 14th of June. So it comes with a high volume bounce, indicating to us there's some form of bullish momentum with conviction coming back into NVIDIA just based on the volume analysis and the price action analysis from the 20-day moving average and the 118.32 first support level that I highlight to you. So initially, if there's no bounce, if the price action have a negative follow through, the next support level will be this 50-day moving average. So given this bounce in NVIDIA and with a higher volume, there could be a chance right now that has already opened up in NVIDIA to resume its impulsive up leg. That means, i.e., this 3-day of down move is considered as a minor corrective downtrend, and very likely this minor corrective downtrend has ended, and right now there could be the start of a bullish reversal to kickstart its bullish impulsive up move within its medium term and major uptrend phase that is still intact. And with this potential positive price action at NVIDIA, it could also influence Nasdaq 100 as well, where the Nasdaq 100 could also start to resume its potential bullish impulsive up move. All right, so now let us now go to the Nasdaq 100 chart itself. So the Nasdaq 100 yesterday, we do have a bearish bias, looking for it to test the rising 20-day moving average that's acting as a support at 19,240, but we do have a short-term pivotal resistance to keep in mind, which is the 19,730, this dotted red line here. So this dotted red line here now managed to surpass it yesterday's, and what we could see over here is that with that current short-term with the current we call it bullish element or positive element that I highlighted in NVIDIA, so there is right now lower odds on the Nasdaq 100 to revisit its rising 20-day moving average, which is at 9240. So perhaps what we could see over here is that the Nasdaq 100 could also start to resume its impulsive up move within its short-term uptrend phase that is still intact. Why? Because it's still holding above the 20-day moving average. And what's interesting over here is that yesterday we do highlight the first support at 19,480 before 19,240, and this 19,480 didn't break and exactly it came very close to it. So initially there was actually a minor sell-off during the European session, but it can't break through 19,480 and continues to trade higher throughout the later part of the European session and throughout the entire US session. So with that, I'll be using this 19,480 as my short-term pivotal support for today, flip to a short-term intraday bullish bias on the Nasdaq 100, given the positive element that I highlighted on Nasdaq 100 and NVIDIA. First resistance to watch will be at this resistance here, 19,840. Above it, potentially revisit 19,990 on a short-term intraday basis for today. Only an hourly close below 19,480 will invalidate today's short-term intraday bullish bias, then thereafter to kickstart another corrective decline to retest the 20-day moving average at 19,240. Right, so that sums up for the short-term intraday technical outlook on the major stock indices. Now, very quickly, let us go on to the commodities market, starting with the gold XAU/USD. So gold XAU/USD, no change, still continues to hover below the 20-day and the 50-day moving average that's acting as a resistance level, but it can't break below the 2,308 level yet, because right now it seems to be testing this level, and momentum continues to remain lackluster while it's going to print a series of lower high. So no change using 2345 as my short-term pivotal resistance for gold XAU/USD. Maintain that short-term intraday bearish bias for gold. Break down below 2308 exposes the next support zone at 2280, 2270, which is the swing low of 3rd of May and 4th of April. Only an hourly close above 2345 will invalidate today's intraday bearish bias to see a push up to retest 2365, which is the swing high area of 21st of June last Friday, and as well as the upper limit of this minor descending channel that is still playing up since the all-time high of 20th of May. Only above 2365 will totally negate this bearish tone to see the start of a much more substantial minor recovery. In first step, the next resistance to watch will be the 7th of June swing high that led to the sell-off or the ongoing weakness in gold, and this sell-off was due to the release of the China FX reserve data that indicate for the month of May, the China authorities didn't bought gold at that juncture. So that level is 2386. Okay, next resistance level to watch if 2365 gives way on the upside. Lastly, West Texas crude oil, WTI crude. So WTI crude, no change. It still continues to hover below the 82.2 short-term pivotal resistance level that we highlighted. Price action on the hourly RSI going to shape lower high, okay, indicating a lack of bullish momentum. So first support level to watch, no change at 80.60. Only a break below 80.60 may expose the next short-term support zone at 79.45/78.90. We saw confluence with the 200-day and the 50-day moving average. Only hourly close above 82.20 will invalidate our short-term intraday bearish bias to see potentially a squeeze up towards the next near-term resistance at 82.90 followed by 84.40. Okay, so that sums up today's short-term intraday technical outlook on the major cross assets. So before we go, let's take a look at the current economic calendar for the latest economic data to look out for in today's session, which is Wednesday. So for Wednesday over here, in the European session, we do have at 2 p.m. German GfK consumer confidence data for the month of July that is released at 2 p.m. Singapore time. And thereafter, we do have ECB official speaking, ECB Lane speaking at 6:40 p.m. Singapore time. And during the US session, we do have some new home sales data out for the month of May at 10 p.m. Singapore time. And pertaining to more related to West Texas crude oil, we do have the weekly oil stockpile release from the US Energy Agency, EIA. So crude oil stockpile change for the week ending 21st June. So that will be at 10:30 p.m. Singapore time. And thereafter, we do have a rather quiet session over here. And this more pertaining to the banking stocks in US. 4:30 a.m. Singapore time, the Federal Reserve, together with the US Treasury, will release this periodically bank stress test report. All right, so that sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.